Hello everybody, I hope you are doing well and safe. My name is Giuseppe Attanasio and I am a second year PhD student from Politecnico di Torino. During the presentation I will go through our proposed methodology to leverage the explainability of associative classifiers to support quantitative stock trading. Now I'm gonna hide my view, my web camera, but I will be back at the end of the slides. Stock markets are known to be volatile as many factors impact on real companies, like financial news, non-financial news, critical events, politics, and so on. Shares fluctuates at a rate of minutes or even seconds. Since values of shares evolve continuously, professional and experienced traders can rely on two sources of information. The fundamental analysis, which makes use of financial insights, such as financial statements, periodic reports on earnings, or ratings, and the technical analysis. This branch exploits several technical indicators that provide quantitative measures. These are evaluated on past candlestick values and the exchanged volume, and their main purpose is to model important aspects, such as the stock recent volatility, or whether it presents a strong trend in behavior, either upward or downward, or its shares are overbought or oversold. Even though it's possible to adapt some fundamental notions and incorporate them into automatic trading systems, in this work we model the information coming from the technical indicators only. The rationale here is that they can always be evaluated at any time scale granularity. On the right-hand side, there is a candlestick chart of Microsoft Corporation, along with two of the most common technical indicators at the bottom, namely RSI and MACD. I use this example to let you grasp the importance of those two instruments. Let's see why. The relative strength index is used to identify either overbought or oversold conditions, and as you can see, it floated above the overbought threshold, which is typically 70, before rallying down during the outbreak of the COVID-19 crisis. At the same time, the MACD line downcrossed its signal line, signaling an upcoming fall of the price, and the same happened again in the opposite direction soon after. So, formally, we have no stationary time series that carry heterogeneous information in the form of numerical features. These are the key elements that soon attracted the machine learning research community. Among the goals, we have been searching for recurrent patterns and ways to model them, inspect the correlation among instruments, or study the impact of other contextual information, stock shares, and indices. The deriving knowledge is frequently exploited to design automatic trading strategies. Those typically make use of machine learning models that are pushed to the maximum predictive capability, but whose decisions actually lack interpretability. Despite more and more works focus on building complex architectures, one might ask, are these systems, or at least their decisions, trustworthy? On one hand, more and more machine learning-powered applications enforce the explainability as a requirement. Critical applications are, for example, healthcare, justice, or autonomous driving. In other applications, high stakes play an important role. Wrongly trading in the market, for example, will lead to high losses. Though, on the other hand, it's difficult to provide a valid notion of interpretability. One solid definition is based on the idea that machine learning models optimize a given metric, for example, the accuracy, but we, as final users, are interested in something else, like a motivation of a given outcome. Hence, interpretability is the tool to bridge this gap. That said, machine learning practitioners have been recently focusing on the properties of transparency of the model. The transparency of a model is given by our ability to either understand its inner atomic parts and functionalities, such as node splits in a decision tree, or to fully understand the learning procedure. Linear models, for example, provide a unique solution to problems. This is powerful because it guarantees that it will be the same also, let me say, in production, with previously unseen data. The gradient-based learning, typical of neural networks, is not fully understood and its convergence shouldn't be taken for granted. Recent works adopt a post-hoc model-agnostic interpretation that provides insights in the locality of the predicted data point. The explanation comes either from a visual or textual artifacts, either by providing the most similar already seen data points from the training set. Also, other methods exist, but I won't dive into them. As we'll see soon, we focused on a decomposable and algorithmically transparent class of models. So far, we have briefly talked about quantitative trading and explainability for machine learning models. Let's see how they are included in the main research questions of our work. Number one, it's straightforward. Can we adopt a transparent model for automatic quantitative trading? And question number two, is this system able to generate profits comparable to those achieved by more complex but non-transparent models? So let's break it down and discuss about transparency first. To address the problem of transparency and interpretability of decisions, we use an associative classifier. Associative classifiers are based on item set and association rules. To address the problem of transparency and interpretability of decisions, we use an associative classifier. Associative classifiers are based on item set and association rules mining. Association rules model the co-occurrence among two disjoint set of items in a transactional database. They are typically provided in the form X implies Y. In red, you can see an example as if it was extracted by a set of sales receipts in a grocery store. So, bread, egg, and bacon implies the presence of Jews. In 1998, Liu et al. Proposed a method to exploit association rules for classification purposes. It mainly consists in a set of associative rules in the form of values taken by the predicted features implied the class label. These are again two examples with imaginary apartment listings. This is a brief overview of the main measures used to assess the quality of rules in an associative classifier. The most common are the support, the confidence, or the lift or interest. Typically, thresholds on these measures are set to retain only the interesting rules and at the same time lower the computational and memory costs of mining algorithms. The proposed system makes use of the live and let live, or L3 in short, associative classifier. Its model is composed of two levels of rules, the level 1, which contains all the rules that correctly classified at least one training record, and level 2, which gathers all the rules potentially useful but that do not cover any training data. In both levels, rules are sorted by descending confidence. During training, the algorithm prunes all the rules that have only misclassified training records, that are known as harmful rules. Finally, the inference is done with majority voting, starting from the top of level 1 and then continuing to level 2 if needed. But let's now describe the actual trading system. We focus on the stock direction forecasting task and we frame it as a classification problem. We will see how in a while. To gain insights into the system decisions, we explore the use of L3 to forecast the next day stock direction. We train the models on relational stock data, and specifically we process the daily stock prices to obtain technical indicators. Next, we use them as predicted features for modeling the current market state. As said before, our target is the one-day ahead relative price variation. The model's predictions are then exploited to operate the stock market. Again, let's break the process down and begin from the data preparation. To overcome intraday fluctuations, we focus on daily data. For each business day, we compute a large set of technical indicators. Then, to apply the associative classifier, indicators must be discretized. We follow the notions from the technical analysis domain and adapt the bins per indicator. I reported an example for the RSI oscillator which goes from 0 to 100. Normally, a reading above 70 should be read as a condition of overbought, while the stock is oversold if it's lower than 30. We further explore two types of discretization, adding a denser one, shown on the right. If you are interested in a complete list of indicators along with the adopted bins, please refer to the paper. For what concerns the class label, we compute the close percentage variation with respect to the next day, and we assign the up or down labels if it goes above or below a given threshold, respectively. In our experiments, this threshold is set to 1%. The preparation stage is applied for each stock separately, and one model each is extracted. The following is an excerpt of rules extracted from level 1 in our experiments. It's worth mentioning again now the decomposability and the inherent transparency of associative classifiers. Just by reading the rule, we, or eventually a professional trader, can grasp the rationale behind the model's either up or down signal. So let's inspect some of them. Here Amazon is deemed as downtrending by the model. This is supported by the negative relative differences between fast and slow simple moving averages or exponentially moving averages, which could indicate a bearish, so downtrending behavior, and a strong accumulation distribution line, which indicate a high exchanged volume. A counterintuitive rule is present for eBay instead. The volume exchanged in recent past days is decreasing, but the ADL indicator is still high, indicating still a high volume pressure. In these cases, expert traders can inspect rules component, match them with their experience, and either refuse the rule or better trust them and gain additional knowledge. The final stage of our pipeline is the actual trading system. So let's see a few key points. First, since the labels are computed on closing prices, we must operate each day right before the closing of the market. In these few moments, we identify the stocks with either up or down predictions, and we sort them by descending exchanged volume, which raises the most traded one in the past days. We then pick only a limited number K of them and open a long selling position for up stocks and a short selling one for down stocks. Once we choose which shares to sell or buy, we evenly distribute the current capital among them. To avoid an effect of over-affection, only one open position per stock is allowed. To refund liquidity in the portfolio, the open positions are closed if they receive a prediction in the opposite direction. And finally, to limit our exposure, we set a stop-loss level of 1%, a maximum number of open positions per day of 3, and a maximum durations for trades of 3 consecutive business days. With the forecasting plus trading pipeline, we tackle the second research question. How does the associative classifier compare to more complex but non-transparent models? And do we need to trade off some of the trading performance for interpretability? So to answer this question, we extensively backtested the pipeline on 11-year historical data, trading on all the listed equities in the US Standard & Poor's Index. We treat each year as a separate dataset to assess the performance under different market scenarios. We used the first 60% of the year as training, the following 20% as validation for hyperparameter tuning, and the last 20% as test set. We compared L3 with a feed-forward neural network, so multilayer perceptron, support vector machine, the random forest classifier, and also the k-nearest neighbor classifier. Here we reported some of the most interesting empirical results. What we can initially see is that the problem itself is complex. On average, the overall accuracy is right above the level of random choice. However, L3 shows a weighted accuracy and a weighted depth score results comparable to those of other classifiers. In most cases, the gap stands on the third decimal digit. Despite the complexity of the problem, L3 achieved the top performance in terms of percentage average return per position in the leftmost table, and moreover it has the lowest number of positions closed at the stop loss level on average. We think this is due to a higher number of correct direction forecasts. These numbers suggest that not only L3 is able to generate results comparable to other classifiers, but also that it is able to generate substantial profits. We hence believe that a further analysis on its rules will potentially lift its trading performance. For a thorough analysis of these tables, please again refer to the paper. Let's see the comparison in terms of equity trends now. We run simulations for each classifier and applying the same trading strategy. These equities refer to the year 2008, which was a bearish downtrending market, mainly due to the outbreak of the worldwide economic crisis. Starting from an initial capital of $100,000, we can see that L3, MLP, and Random Forest led to a higher profit, mainly gaining advantage on late November. Also L3, the purple line, ended at the top of this group, with more than 30% of profit overall. The year 2014 was instead characterized by a market with a mixed trend. The conditions clearly make trading harder. In fact, we can see that almost every classifier did not improve the initial equity except for the support vector machines. However, again, L3 is on top positions and achieved a limited loss compared to most other models. We provide also an example for bullish year, so an uptrending market. In 2010, when the long-tailed effects of the crisis started to ease, L3 was deemed as the most reliable classifier by far, since as you can see, it was the only one leading to profit. Again, these results suggest that reliable trading strategies can be based on transparent associative classifiers. And finally, since, as we previously discussed, the search space of associative classifiers is bounded by the minimum support and confidence thresholds, we carried out a sensitivity study on those. The results show that, on average, a higher minimum support threshold generates a poor descriptive model, while decreasing it improves the performance. The benefits of a lower minimum support threshold then saturates, which is good, because remember, the lower this threshold, the bigger and more difficult to describe is the model. Instead, experimental results reported that a high minimum confidence level is required to achieve positive returns, and that there is a significant performance degradation lowering it. Here, these behaviors are highlighted in a sample year of our experiments in 2014. On the left, we have an equity line for different values of minimum support thresholds, and on the right, the heat map that highlights with a lighter color the configurations that provided the best results. So to sum up, let's see some takeaways. First, even if it was not reported, these results were achieved with the fine-grained discretization levels, which in most of the cases achieved better results than their coarse counterparts. Then results show that associative classifiers perform as good as other standard techniques. And finally, that while we use an associative classifier, low to medium support threshold values are recommended. So to conclude, in this work we propose an automatic trading strategy based on associative classification models for quantitative stock trading. This inherent transparency of the model let us explore the actual body of the rules, fully explaining the why the trading signals are provided. And finally, we empirically proved that the proposed approach performs at least as good as other established machine learning models. Our future work is mainly focused on rules understanding. For example, we might ask, are there any common or recurrent patterns in extracted rules? Or are there rules more profitable than others? Or lastly, do they match with the technical analysis fundamentals? Well, this concludes my presentation. Thank you for listening, If you have any question, feel free to ask, even offline, to one of my contacts. Enjoy the rest of the conference. Bye.